Oil just hit the 95th percentile, and oil at this percentile has preceded demand destruction in 4 of 5 cycles. Something is breaking beneath the surface, and the data confirms it. Right now, oil is at $97.6, the 95th percentile for the past year. Historically, oil at this percentile has preceded demand destruction in 4 of 5 cycles. McElroy says oversupply and multifamily will pressure rents in Sunbelt markets. Hartman says real estate is the best inflation hedge. Rents only go up. In the next few minutes, I will show you who the data says is right and what it means for your money this week. The commodity analyst has been right for 103 straight days. Here's the full scoreboard. The commodity analyst commodity supercycle call is paying off. Oil at $97.6 and trending their direction. 103-day streak. Score 1 for Gammon. Credit will blow out. Investment grade spread agrees at 83 basis points. 27-day streak. Too early to call McElroy right or wrong. The thesis is building but not confirmed. 102-day streak. Too early to call Hartman right or wrong. The thesis is building but not confirmed. 96-day streak. Too early to call the dollar analyst right or wrong. The thesis is building but not confirmed. 12 days running. Too early to call the volatility expert right or wrong. The thesis is building but not confirmed. 12 days running, Snyder is wrong. For now. Yield curve at 0.51% is moving against the thesis. 12 days running score today, 2 right, 4 early, 1 wrong. Long streaks are powerful until they break. Track the signal, not the conviction. Today's big question, is real estate still a buy? Or is affordability killing the trade? On one side, McElroy says oversupply and multifamily will pressure rents in Sunbelt markets. That is the setup. Everyone hears it on the podcast. It sounds convincing. On the other side, Hartman says real estate is the best inflation hedge. Rents only go up. Two smart people, opposite conclusions. So who is right? Here's what the data says. 30-year mortgage at 6.37%, down 1.4% today. Bottom line, right now the data leans toward McElroy. Watch the signals this week for confirmation. If mortgage rates drop below 6%, the housing bulls get a second wind. Right now, they're at 6.37%. If rates hold above 7% for 3 months, affordability kills the recovery thesis. 30-year mortgage at 6.37%, we'll track it daily on the scoreboard. None of the 7 are talking about this next signal, and they should be. High-yield spread just dropped 5.8% to 294 basis points. A move this size demands attention. Historically, high-yield stress at this level signals institutional risk aversion building. None of the 7 are talking about this. Keep it on your radar. Phase 1 is the good times. But good times do not last forever. Here's how close we are to the edge. We are 67 basis points away from Phase 2, the phase where credit breaks and volatility spikes. There is no acceleration in credit stress yet, but we are watching the pace, not just the level, the trigger, investment-grade spread crossing 150 basis points. Currently at 83 basis points. Pace is flat or improving. No urgency right now. Phase 1 means risk on is working. Equities, commodities, and real estate all benefit from loose conditions. Enjoy it while it lasts. For context, the last time credit stress built like this, credit spreads blew out and high-yield bonds saw drawdowns of 15%. The credit and rates layer has yield curve, initial jobless claims flashing red. Gammon says the Fed is breaking things and credit spreads will blow out. The data agrees with that assessment. Phase 1 holds with 67 basis points of buffer. Conditions favor risk, but do not get complacent. Wall Street trades the index. We trade the ground. Here's what the ZIP level data is screaming about today. Marin, CA, payment burden is past the breaking point. Bolinas, CA, median home about $1,824,000 on about $96,000 household income. Price to income ratio, 18.9. When the math stops working, sellers find out before buyers do. Lee County, FL, payment burden is past the breaking point. 33,921 FL, median home about $2,337,000 on about $122,000 household income. Price to income ratio, 18.9. When the math stops working, sellers find out before buyers do. Anchorage, AK, people moving in can't afford to live here. 12,110 households moved into Anchorage, AK. Their average income, about $64,000. Median home, about $699,000. Unsustainable migration pattern, demand without purchasing power. These are not hand-picked metros. They are the loudest signals in the housing data right now, chosen by the numbers, not the narrative. Today's debate asked, is real estate still a buy, or is affordability killing the trade? Let me show you what happened the last time we were here. Oil at $97.6 is in the 95th percentile. That means it is higher than 95 out of 100 days in the past year. In 2022, oil spiked above 120, then demand destruction pulled it back 40% in months. In 2020, oil went negative for the first time in history as demand collapsed. In 2018, oil dropped 40% in Q4 as growth fears overtook supply concerns. Different environments, different catalysts, but every time, the resolution came fast. The pattern is not the level, it is the speed of the move once it starts. Meanwhile, copper at $5.82 is in the 88th percentile. The last time both oil and copper were at these levels simultaneously, the resolution came within weeks. That is why the scoreboard matters. It tells you which speakers saw it coming and which ones missed it. If history rhymes, McElroy is on the right side of this trade. The data is not ambiguous. Here is what the data says to do right now. Do not chase oil here. The 95th percentile is reversal territory, not an entry point. Avoid Denver at 36% payment burden. That is stretch territory. Watch high yield spread. It dropped 5.8% and nobody is talking about it. Every signal is live at analyze.builderslens.com. The podcasters give you the thesis. We give you the scoreboard. Subscribe and I will see you tomorrow morning.